Ladies and gentlemen, my name is Ananda Bhaumik and I live and work in Hong Kong. Thank you for inviting me to speak. When Joel asked me to speak, he gave me a one-line instruction. He said, make it a TED style presentation, whatever that means. And he will be speaking about technical analysis to treasury professionals. When I started preparing, I realized that I have an important issue to tackle. And when I saw the program, I realized I have two issues to tackle today. The first issue is the audience. There have been many surveys in the last 3 decades amongst FX and rates traders in the dealing rooms of London, Tokyo, Singapore, and Hong Kong, which showed that anything between 60 and 90% of the professionals use or are familiar with technical analysis. And Mumbai today is a very important center, may not be as important as the other centers in terms of volume, but definitely in terms of intellectual sophistication of the market participants. So I'm wondering if I'm trying to sell ice to Eskimos or if I'm preaching to the converted. The second issue, you have heard from the best already about macros and technicals. You have heard from a central banker. You have heard from two market-oriented academics from NIBM, a cutting-edge data-driven analyst who was also a board member of the CMT not so long ago, and the executive director of the CMT Association, whose hobby is to make complex technical analysis outputs visually appealing and make the process appear simple as well, just like Shekhar Gupta's Cut the Clutter episodes. In fact, this phrase, cut the clutter, gave me an idea and an inspiration to term today's presentation, to label today's presentation as Back to Basics. Let me begin by bursting one myth. You know, and I know, and the CMT Association knows that fundamental analysis and technical analysis are twins joined at the hip. But the fact is that one of them is the older sibling. Technical analysis predates fundamental analysis by 200 plus years. And I learned about this only a few months ago. You might be thinking, I know, you must be having Munehisa Honma in mind, the father of candlesticks who used to trade rice futures in a market near Tokyo. Unfortunately, that's not the correct answer. I have this gentleman in mind, Joseph de la Vega. He was a Spanish gentleman trading stocks in Amsterdam Stock Exchange, which, as you know, is the world's oldest, having started in 1602. And in 1682, he wrote a book whose name, unfortunately, I can't pronounce very well, but in English it's called Confusion of Confusions. And it's probably the earliest known book to show how a stock exchange works. It describes very clearly excessive trading, overreaction, underreaction, and what we now call the disposition effect. A few modern writers of finance have termed him as the father of behavioral finance. The other gentleman, Munehisa Honma, also wrote a book in 1755 called The Fountain of Gold, The Three-Monkey Record of Money, in which it describes the role of emotions and how these could affect and even predict rice prices. Honma, like De la Vega, was perhaps one of the earliest documented practitioners of behavioral finance. With that established, let me try and begin, as they say, at the beginning. Some of you have seen and met and heard Ken Tao when he was in Mumbai about a month ago. He had also come to Hong Kong and he made a presentation, hour-long presentation, followed by a 30-minute discussion to the members of the Hong Kong chapter of the CMT Association. And during that 90-minute period, several times he mentioned that the basic principle on which the company's model is built has remained unchanged since the early 80s. The only change has been that technology has allowed him to cover a broader range of asset classes and many more equity markets around the globe. The point I'm trying to make is that technology helps the process, but new ideas can be powerful and very simple as well. I will touch upon this a few slides later. So what is it all about? It's all about the tell. You have heard of the expression poker face. Well, tell is an inadvertent behavior or mannerism that betrays a poker player's true thoughts, intentions, or emotions. You may have seen Suhani Shah. You may have seen her perform live or on TV shows. You may have also seen the YouTube videos of Lior Suchard. These two seem to have a near psychic ability to extract the deepest of secrets from a person, like a person's ATM PIN code or the name of his first girlfriend or her first boyfriend. And without these persons revealing or saying anything. You may have also seen the shows of Deepak Rao. He has performed in many corporate events in India and abroad. When I first met Deepak about 2 decades ago, I asked him after the show, how did he do it? Deepak told me that we humans are leaking information all the time, and anyone can be trained to read the information. It is a skill that can be taught. The market too, or the markets are also leaking information all the time. And technical analysis is about teaching somebody or learning how to read the information that the market is leaking, what the market is telling us. At the most basic level is the price bar or the candlestick. Gentlemen, ladies and gentlemen, I'm not trying to insult your intelligence. You know everything, but I've got to begin at the beginning to prove a point. So please bear with me. Humor me for a few minutes. At the most basic level is the price or the candlestick. There's a lot of information contained in a single or a group of price bars or in a lone candlestick or in a group of candlesticks. Candlesticks, of course, are very evocative names and they are visually very effective as well. But all of them, whether it's a bar or a candlestick or a group or in isolation, they all tell a story. We just have to be observant enough. One of the easiest to spot is the outside day reversal bar. Outside days are a two-bar price pattern where the difference between the open and the close on the second day is larger than the first day, than the previous day, and the open and close on the second day are outside the range of the first day. In the stock markets, it works very well. In a 24-hour market like the currency market or the cryptocurrency market, except except when there is a weekend, it doesn't apply to cryptocurrencies, of course. In the case of currency markets, there is really no gap except in a weekend, except over the weekend. So the second condition may be ignored in a way. But if the outside day reversal bar occurs after a reasonable uptrend or a downtrend, it's a reason to sit up and take notice. Here is an example from Bitcoin, 25th November 24. By the way, I'm recording this on the 27th, so some of the charts that I will try to show you at the end, if time permits, will not be updated because you are watching this on the 4th of December. Anyway, this is from Bitcoin Daily, 25th November 24. This is the bar. This is an example, Swiss yen, 8th of July 24. And this is a candlestick, the equivalent of the outside day reversal, which is called the bearish engulfing in this case. This is from Young China Holdings, listed in the US. The body of the bar completely engulfs the body of the previous bar. Here is an example. Here are two examples from sterling rupee, 25th September 24 and 6th November 24. They both look a little messy, especially this one. But here, there is a pattern called micro M top. It is formed over a few bars and it looks like a distorted M. And the reverse is the micro W bottom. And I learnt about this from a gentleman called Tom Bjorvik, who had come to Bangkok in 1996. More about him, excuse me, a little later. This is an interesting slide. This is a snapshot of a portion of a site maintained by this gentleman by the name of Thomas Bulkowski. And his site is called thepatternSite.com. He has tested hundreds of bar, candlestick, and chart patterns and has assigned to them probabilities of success. This is an example. We just spoke about bearish engulfing, and he has assigned a 70%, 79% chance of success, but with a caveat. The caveat is, he says, the bearish engulfing candlestick does not imply a lasting reversal. Hold that thought for a second. This is a portion from his site, a snapshot of his site, which shows the best performing candlestick patterns. Just look at this, 84% bullish reversal, 3-bar strike, he calls it. He has also written a book, Encyclopedia of Chart Patterns, but believe me, it's tough reading. My eyes glazed over. I'm sure yours will as well. But you don't have to read the book. You go to the website. It is free and it's got tons of information. He also writes a commentary every day and I read it every weekend. The commentary is on the US stock indices. It has gems like this one. Trade bullish candles in an uptrend, that is when a correction takes place, and trade bearish candles in a downtrend. Sounds very obvious, but you know what? He actually proves it. Now, we cannot just trade on the basis of a few patterns. Some probably do and make a lot of money, but most of us, when we need something else, for example, we need to determine what is the trend of the market. We can determine trend in many ways. We can draw a trend line. We can do it the old-fashioned way, lower highs, lower lows, lower highs, lower lows, and the reverse in a downtrend, or we can use moving averages. Let me introduce you to a very interesting way of determining a trend. Some of you may already know about it. I came to know about this from a gentleman called Thomas Bjorvik, whose name I mentioned a few slides ago. He had come to Bangkok in 1996, if I remember correctly, as part of the Dow Jones seminars. Tim Slater had started the TAG, or the Technical Analysis Group, in the US in the early 80s. And over the next 2 decades, he would take a group of established and quite well-known practitioners of technical analysis on a tour of cities around the globe. I have attended quite a few in South and East Asia. Bjorvik's logic was simple. In an uptrend, the close should be higher than the open, and in a downtrend, the close should be lower than the open. And what did he do? He took a 9-period simple moving average of the close and the open to determine the trend, to define a trend. Now the question is, why a 9-period? Many of you may not know, but it was Wallace Wilder who sort of popularized 14 and 9. Remember, 14-period RSI, 14-period ADX, etc. Why 14? Because Wallace Wilder used to believe in astrology, and 14 is half a lunar month, and 9 is a third of a lunar month. Where did I learn it from? This is very interesting, and please listen to this very carefully. I learned it from an episode of Fill the Gap podcast, co-hosted by Dave Lundgren and Tyler Wood, who is sitting right here in this room. And this is one of the men, and Fill the Gap is one of the, it's available on the website. It's available on Apple Podcasts, on Spotify, and the best part is it has a transcript. If you don't have the time to listen while you're taking a walk or on your stationary exercise bike, you might print out or you might just read the transcript. This is one of the, it is one of the many free gems, as I call it, really free and gem that the CMT Association has. And I learned this from an episode where the guest was Mark Newton of Fundstrat, and he mentioned this. You do not need to be a member of the CMT Association to access these free pages, these free gems, but I strongly, strongly urge you to become a paying member and also take the 3-level exams that qualifies you to be a CMT charter holder. Okay, now you have to put everything together. And in this case, I have put together in a very simple fashion a few things. You can see the bar chart. You can see the 9-period SMA of the open and close. I have added super trend, which is available on TradingView. You may or may not use it. I will not go into any detail, but I have added one of my most favorite indicators, the MACD and the MACD histogram. You can see the divergence here as well. I use MACD histogram, but I do not use 12.26.9. I use 5.34.5. I learned this from a gentleman by the name of Dr. Bill Williams, again in a Dow Jones seminar from 1990, if I remember correctly. He said he used 5 and 34 as oscillators to determine the, as histograms rather, to determine the state of the Elliott waves. For example, the largest histogram, up or down, positive or negative, would determine the third wave, would show the third wave. And if there was a small divergence, the next one was lower in height, for example, than the previous one, then it would probably show a fourth or a fifth has ended. I do not do that, but since then I've been using 534.5 and it works very well for me. Now, you might like to declutter a bit. You might like to remove the 9-period open and SMA of the open and close and convert it into a histogram. So here you see the micro M top here, the outside the reversal bar here, divergence has taken place, and you can see the 9-period close has gone below the 9-period open here. You may like to trade when the trend line breaks or any way you want that suits you. Now, why am I telling you all this? The purpose of all this is to show to you that it is possible to trade and invest using simple ideas. A powerful illustration of this, what I've just said, are the Dow award-winning papers, another free gem from the CMT Association. You can go and read them. I strongly urge you to go and read them. The CMT Association has 6 annual awards. One of them is awarded to the author of the paper to highlight outstanding research in technical analysis. The last 3 papers stem from very simple propositions which have been available publicly for the last 50 years, but all of them have been rigorously researched, and the conclusions drawn were unique. Before I mention the papers, let me point out what I learned from one session at the 50th anniversary celebrations of the CMT Association in 2023. I was very fortunate to be there. Tom DeMark of the famous DeMark Indicators was being given a Lifetime Achievement Award. And during a discussion with Larry Williams, Larry mentioned how Tom used to send him pages and pages of marked charts as he was working through and refining his famous 9s and 13s. Tom DeMark probably has 70 indicators under the DeMark label, but his 9s, his counter trend 9s and 13s, are probably the most useful as far as I'm concerned. Probably the use of AI these days can speed up the process, like it helped to predict the complex ways proteins fold, and the pioneers were awarded the Nobel Prize in Medicine in 2024. But the ideas can be very simple, and you can still work manually. I mean, manually means using spreadsheet and computers. AI can also speed up the process, but manual, it's possible to do it manually as well. That's what I was saying. I'm trying to say. So let me spend a few minutes on the last three award-winning papers. Larry Williams won the prize in 2024 jointly with Ralph Vince for his optimal F. They built their bloodbath indicator, rather bloodbath avoidance indicator, based on a simple rule of 4% of daily new 52-week lows. Andrew Thrasher, a young man who won the prize in 2023, his paper is called The 5% Canary, and it showed that the amount of time taken for the S&P 500 or the Dow Jones Industrial Average to decline by 5% from a 52-week high provides a strong indication of future price action. Both the papers were built upon the work of many who have worked on similar issues in the last 50 years, but both papers managed to draw conclusions that were unique. Market breadth and 52-week highs and lows have been in the public domain and researched thoroughly by many over the last 50 years. And these papers were based on these two simple and publicly available concepts, but yet they were able to draw conclusions that were unique. My favorite is the 22 paper by Alex Spiroglu. It's called the MACD-V, or Volatility Normalized Momentum. MACD is my favorite indicator, and I use the PPO quite extensively. But I want to spend a little time on the MACD-V. Alex sent a message over LinkedIn about 6, maybe 9 months ago, said that his indicator MACD-V was available on stockcharts.com and I should go take a look. And I did, and I really, really like it. MACD is the difference between 12 and 26-day EMA. Signal line is 9-day EMA of the MACD line, and the MACD histogram is the MACD line, is the difference between the MACD line and the signal line. The PPO, or the percentage price oscillator, was an improvement over the MACD. You see, when the price moves up suddenly, then the MACD shoots up as well, and the previous gyrations of the MACD, they become compressed and becomes very difficult to read. The PPO was an improvement over this because it sort of made the MACD into a bounded oscillator. So what was the difference? Everything is the same, except that the difference between 12 and 26-day EMAs, the difference is expressed as a percentage of the 26-day EMA. This makes the PPO a bounded indicator. It works very well, but Alex showed it still has problems. For example, between 1975 and 2021, the S&P 500 remained between minus 0.2 and plus minus 2 and plus 2. while the natural gas moved between -7 and +7, and the German Bund between -0.5 and +0.5. It PPO made it possible to compare different asset classes, but there were still issues. To improve on that, what Alex Baroglu did, he took the difference and he expressed it as a percentage of the average true range of the last 26 days. Mind you, average true range is a concept that was unveiled to the world by Wallace Wilder in 1978. And Gerald Apple introduced the world to the MACD just about that time. So Alex took those two simple concepts and made a very important innovation. MACD-V allows one to compare different asset classes, different tradables, and it always moves between +2 and -2. I won't go into detail. Please read the paper. It's really very fascinating. I will now change gears and go to the fundamental side of things. I've already spoken for about 25 minutes approximately. So let me spend a few minutes on fundamentals. If I was an FX analyst today, then my workflow triangle would look something like this. Right at the bottom would be the fundamental stuff. PPP, purchasing power parity. Think of the Economist magazine's Big Mac index, or the not so very popular Starbucks index. The N and R, nominal and real effective exchange rates. And I would update the regressions of the currency pair that I'm looking at to determine the effect of different factors on the exchange rate, from yield differentials, inflation differentials, commodities depending on the currency pair, even the local or specific foreign stock index, again, depending on the currency pair. For example, I would look at the effect of the SPX on the euro, on the dollar euro, or the euro dollar, amongst other things, and the effect of oil prices on the Canadian dollar. I would have a monthly model based on economic data, which is rarely published more frequently than monthly. I would have a model for weekly data over the last 52 weeks and a daily model as well that would look at that looks at say 60 days of prices, financial and commodity prices. I would look at flow, capital flow. Capital flows affect exchange rates, debt and equity flows across borders. I remember about a decade ago when I was in a bank called Pictet, State Street would send us a weekly report, not send us, send the investment advisory desk, a weekly report which would show color coded flows. Different shades of green showed inflows, and different shades of red showed outflows into different regions and countries of the world. And State Street was sitting on this information because they are the largest, or at least the top two, along with BNY Mellon, custodians of assets. And currently, State Street has over $45 trillion of custodial assets, so that they can really see how the flow is taking place. I would then look at CFTC reports, especially positions of the non-commercial traders or speculators, as they're called. Speculators are often reviled in times of crisis, but you know and I know that without them, there'd be no markets. I would also look at risk reversals, 3-month 25 deltas. And to top it all, I would use technical analysis. I must also mention that I like the beer model, not only because it's the latest, but I like the name. And I must mention that for a long time, I thought B stood for Bloomberg. Anyway, I am not an analyst. I'm not a fundamental analyst. I love technical analysis. I believe technical analysis. So that would form the floor of my analytical approach to the currency markets. Of course, I would look at flow and positioning, especially positioning, because I need a story when I need to explain something to the client. It is easy to tell a client that the speculators in the currency pits of Chicago are terribly short yen and their positions look overstretched, which makes the probability of yen strengthening higher than it was a few months ago. That was a mouthful. Rather than telling the same guy, that the same client, that the dollar should weaken against the yen because a head and shoulders is about to be triggered on weekly charts. The best part is that all the stuff that I have mentioned, especially regressions, which had to be rather painfully maintained 15 to 20 years ago, is now they are all available for the asking on Bloomberg and on the LSEG terminal as well. I don't know why Reuters' name could not be kept. I think LSEG should change the name to LSEG data terminal. In fact, a lot of people don't say LSEG at all, they say LSEG. Anyway, bad joke. Having said that, the most important fundamental factor for most of us is the actions of the central bank of a country. The central bank is the biggest gorilla in the room, and all of you have heard the expression never fight the Fed. I would say never fight a central bank, any central bank. The the biggest power, the strongest power the central bank has is not only the the powers of the central bank, two powers especially, not only the power to set interest rates, but also the power of intervention, coordinated intervention especially, though we haven't seen a large and coordinated intervention in the last decade or so, though we have seen a lot of jawboning, as the expression goes. The last major coordinated intervention was in 2011 after the Tokyo tsunami to dampen the sharp yen rise. The famous tsunami which destroyed a nuclear power plant as well. There was speculation after the tsunami that Japanese firms would sell their foreign currency assets and repatriate the yen to pay for reconstruction of the destroyed places. Mind you, the low in the dollar took place in October 2011 at 75.68. Excuse me, I'll show that chart in a second. Coordinated interventions succeed. Lone attempts by central banks usually do not. The Bank of England's attempt to defend the sterling in 1992 when it left the ERM is a story by itself, and many of you may have experienced it in the trading room when the quotes were 1.82, 1.83, take it or leave it, instead of, let's say, 1.830102. The government displayed a lot of hesitancy at the beginning when it was planning to join the ERM, and when it did at a very inflated sterling mark exchange rate. And they had to withdraw because it was not sustainable. They also failed to defend the pound. They made a half-hearted attempt. They even raised the base rates twice during the day, up to 15%, but they had to give up in the end because the speculators were very powerful. Traders had known this for a while, that the Bank of England or the UK would have to exit the URM, so they were shorting the currencies. But one of the biggest players you and I know, and it's become part of the legends of foreign exchange markets, is the shorting of the pound by George Soros and his protege Stanley Druckenmiller. They made £1 billion apparently. Though the actions cannot be compared, there have been successful attempts by lone central banks to defend the currencies. I remember when the baht was devalued in early July 1997, it went quickly from 25 to over 50 to the dollar. It also set in motion a string of crises across Southeast Asia. The Korean won weakened a lot, and the Indonesian rupiah, I remember particularly, went from 2,000 to 16,000 in a very short while. The Hong Kong dollar was also attacked in October 1997. But the HKMA, the local equivalent of the central bank of the city-state of Hong Kong, the Hong Kong Monetary Authority, managed to defend the Hong Kong dollar successfully because one, the Hong Kong dollar was pegged at 7.8 to the dollar, and two, the HKMA raised the overnight borrowing rates to 200%. When you short a currency, you have to borrow it, like when you short a stock. By raising the short-term rates to unsustainable levels, the HKMA killed the speculators. By the way, the Hong Kong dollar has been pegged to the US dollar at 7.8 since 1983, and it is one of the most successful currency pegs in the world. There have been attempts by others, as late as 2022, for example. Bill Ackman publicly announced in 2022 that he was short the Hong Kong dollars. And Jim Chanos, if I remember correctly, who had to close his short hedge fund, he has been bearish on China and in Hong Kong, on Hong Kong, especially Hong Kong dollars, for a long, long, long time. He was. But I think those who want to short the Hong Kong dollars forget that the Chinese central bank is there with its multi-trillion-dollar reserves and expressed support. So it is a losing game to try and short the Hong Kong dollar. I sound like a spokesperson of the HKMA. Anyway, the most successful intervention that I have seen in the last 45 years was the one that took place after the Plaza Accord in September 1985. The position of Japan those days was that of China today. Yen was weak, 260 to 70, and it was Japan, as usual, was manufacturing world-class products and selling it to countries all over the world, especially to United States, because the US is a big vacuum cleaner sucking in imports from all over the world. It did at that time, it does even today. And therein lay the problem. I remember seeing pictures of members of the UAW striking, I think in Detroit or Chicago, I don't remember, probably Detroit. And I've seen pictures of graffiti on the walls of industrial buildings. One of them read, "Go park your Toyota in Tokyo." So the United States and the G5, West Germany, France, the United Kingdom, and Japan got together, and it was initiated by the US, and they signed an accord in the Plaza Hotel in New York in September 85, and they decided to sell the dollar, and they did. I have to point out that the dollar was already turning down when the intervention took place, so the timing was perfect. So they sold it down all the way to February 87, when there was another accord, again on the initiative of the United States, called the Louvre Accord. At that time, it was G7 with Canada and Italy. Italy didn't sign the declaration, but Canada did, and they decided to support the dollar, managed to push it up, but it came down again. But before I go into this area and this area, I want to tell you a story, a personal story. It was late March 1987. I used to be working in Bangkok at that time, trying to set up a treasury for a Thai bank. And I received this call from this gentleman, 15 to 18 years my senior. he was in Hong Kong. He calls me and asks me what I thought of the dollar yen. Let me give you a little bit of a background. He was in private banking at the time, and private banking was a little primitive at the time. Banks took deposits, traded FX, traded equities, and in Southeast Asia, there was a popular portfolio where you bought US dollar investment grade bonds and leveraged them by borrowing Japanese yen and Swiss franc because the currencies were weak and the interest differential was in favor of the dollar. So when I asked this gentleman why he wanted to know my opinion about the yen, the dollar yen, he said the leveraged bond portfolios in his clients' portfolios had an average borrowing level of the yen of 120. And here was dollar yen breaking 80. It was mid to late. It was around 87 at that time when he called. So he asked me what I thought of the dollar yen. I looked at the daily chart. It looked to me there was a little divergence possible happening here. The slow stochastic was crawling along the bottom barrier. I decided I should look at the weeklies. I looked at the weeklies. It looked to me that some sort of a 1, 2, 3, 4, 5 is taking place. But then I said, why not I look at the monthlies? And I did. And to my untrained eye, it looked to me like a 5 was, and mind you, this is from 1983. The Plaza Accord took place here. So 1, 2, 3, 4, 5 looks like a 5 which is not finished yet. A monthly divergence is a possibility. And here was the slow stochastic crawling along the bottom. So, with all the confidence in my command and knowing fully well that as an advisor, a forecaster, an analyst, we are only as good as our last call, I told him that if he could hold his position a little longer, he should, because it appeared to me that the dollar is probably close to a bottom than it was a year ago. He said, thank you. And the dollar luckily bottomed within a few weeks. He remembered that. He remembered me. And about 9 years later, when I was looking to change my job, he made a fantastic introduction. I really shouldn't be talking about Elliott wave today because we have Akshay sitting in the audience and he is an Elliott wave expert. And Dr. Roy Trivedi, the co-author of the book that Dr. Trivedi wrote, Ashish Kayal, he's also an Elliott wave expert. I don't know if he's present here today. Anyway, that was the story. I want you to take a look at the right-hand side, at here. To me, of course, if you look back now, it looks really like a 1, 2, 3, 4, 5 with a monthly divergence clearly visible. But you know, on hindsight, we all have 2020 hindsight. But the problem is when you have to take a decision when on the right side of the last bar is nothing but white space. And that is a problem, we all know. Anyway, this is a huge head and shoulders. Forget about this measuring what I measured here. The measure is between 168 and 172. I used the monthlies. I should have used the dailies to get a more accurate reading. But I learned about this not only from Martin Pring, who takes very long-term views. In fact, just about 2 weeks ago, he wrote an article about his long-term view of the dollar, and he's very positive. But I also learned to take a look at patterns on weeklies and dailies from another person, by the name of Brian Marber. Brian Marber is, in my opinion, is the funniest writer in technical analysis. He has written only one book. It's called Marber and Markets: How to Make Money from Charts. By the way, it's available in Crosswords. Please go and take a look at it, if not buy it. He he was a pure technician and used to manage money based simply on technical analysis. Please look him up. He is a great guy. He was also very, very funny. For example, he writes, he lasted in Bloomberg for just one day. Bloomberg employed him, set up the terminal at his home office, and on his first day at work, which happened to be the day after after a solar eclipse, the studio calls him and asks him, "What do you think? What do you think was the effect of the eclipse on the markets?" And in typical Marvel fashion, he said, "I'm so sorry, it was so dark, I couldn't see anything." Anyway, he is always full of irreverent, his book is full of irreverent quotes. One of them is, "Anyone who tells you it's, that is technical analysis, anyone who tells you it's a science is a charlatan or con artist, not a chartist." I have spoken for almost 45 minutes. I will take 2 minutes to show you my go-to template. My go-to template is very simple. I use this template to scroll through at least 100 charts of commodities, equities, country ETFs listed in US, currencies, and cryptocurrencies. This is a chart of dollar yen, and it's a weekly 7-year uh, spread. The blue line is a 40-week simple moving average, and the orange line is the 10-week simple moving average. This is the MACD. When I was explaining the MACD-V, this is what happens when price shoots up suddenly. The the previous gyrations become compressed and very difficult to see. That's why a PPO is a better option. I will change over to PPO soon. Anyway, so there is a divergence. I can see that. You can see that. You can also see the 1433 slow stochastic, and I want to spend 30 seconds here. The lines have been shifted. They're not 80-20, and I think I learned it from Dr. Alexander Elder's book. I also watched him in one of the Dow Jones seminars in the early 90s. He said, if remove the upper and the lower bands to make sure all the major turns are enclosed. So that's what I do. This is Swiss yen. And in my humble opinion, that, mind you, you are watching this on 4th of December. This chart is from 25th of November. I use MACD not only for divergences, but and the signal line and crossing the MACD line and the histogram, but also for trend line breaks. This is an important indication for me, and I'm sure you use it as well. Anyway, all I'm saying that the yen, if it tries to express its strength, it will probably be seen in Swiss yen first, short Swiss, long yen, then against the dollar. This is Swiss yen. That was weekly. This is daily. I can see a head and shoulders. It's a little messy here, but I think this will break, and it is worth going long yen and short Swiss. Here is the dollar yen daily chart. Trend line is about to break. The divergence is not so clear and not so perfect. So with a little help from the BOJ, we may see a stronger yen. There is definitely a trade here. Now, this is a Bitcoin chart, and I want to spend the last minute here. Technical analysis requires liquidity. I keep receiving charts from friends of mine who have retired and also from younger, inexperienced analysts who send me charts of stocks, very liquid stocks. And I keep telling them technical analysis does not work if there is no liquidity. This is weekly Bitcoin. Look at this. Bitcoin has no central bank to govern it. Bitcoin has fundamentals, mind you, if you know how to read those. And it trades 24/7, 365 days a year. So it's perfectly amenable to technical analysis. This is weekly. Maybe it is turning down. I can see the beginnings of a divergence. The last chart, the famous outside day reversal. This is 27th of November, and I'm recording this after I printed this chart. And that's about all. I've spoken for 50 minutes. I hope I have been able to give you, impart some information. I will definitely not call it knowledge. And I hope you have found it useful. Thank you for listening. And thank you once again for inviting me to speak.